Most people think financial crashes are rare, unexpected, unpredictable, almost like accidents. Something goes wrong, and the system breaks. But what if that's not actually true? What if financial crashes aren't accidents at all, but something the system naturally produces? Because if you step back and look at the bigger picture, a pattern starts to emerge. The economy grows, markets rise, confidence builds. Everything feels stable, even unstoppable. And then, suddenly, everything changes. Prices fall, markets crash, businesses shut down, people lose jobs, panic spreads. And for a moment, it feels like the entire system is breaking apart. But then, slowly, things begin to recover. Confidence returns, markets stabilize, growth resumes, and before long, it feels like everything is normal again. Until it happens again. The same cycle, over and over. So the real question isn't just why crashes happen. It's why they keep happening. To understand that, you have to go deeper into the structure of the system itself. Because what we uncovered in the last episode is the key to everything. The system runs on debt. And debt has a very specific characteristic. It expands. Every loan creates more money, but it also creates more obligation. Because every dollar borrowed has to be paid back. With interest. Which means over time, more is owed than actually exists in the system. And that creates pressure. At first, that pressure drives growth. People borrow to buy homes, businesses borrow to expand, governments borrow to spend. And as borrowing increases, so does economic activity. More spending, more investment, more growth. Everything moves faster. Asset prices rise. Stocks go up. Real estate values increase. And this creates a powerful feedback loop. Because as prices rise, confidence rises. And as confidence rises, people take on even more risk. They borrow more. They invest more. They assume things will keep getting better. This is the expansion phase. And during this phase, everything looks healthy. But underneath the surface, something else is happening. Debt is growing. Not just growing, but accelerating. Faster than incomes. Faster than productivity. Faster than the real economy. And this is where the imbalance begins. Because eventually, the system reaches a point where it becomes stretched, where borrowers are taking on more than they can realistically handle, where prices are no longer supported by fundamentals, but by expectations, and expectations can change very quickly. This is where fragility enters the system. At this stage, the system looks strong, but it's actually vulnerable. Because it depends on one thing continuing: confidence. As long as people believe things will keep improving, the system keeps expanding. But the moment that belief starts to weaken, everything starts to shift. And that shift is what triggers crashes. It usually starts small. Maybe interest rates rise slightly. Maybe borrowing becomes a little more expensive. Maybe growth begins to slow. At first, it doesn't seem like a big deal. But small changes in a highly leveraged system have large effects. Because when debt levels are high, even a small increase in pressure can create stress. Borrowers struggle to keep up with payments. Defaults begin to rise. And when defaults rise, lenders react. Banks become more cautious. They tighten lending standards. They issue fewer loans. And this is where the system starts to turn. Because new debt is what keeps the system moving. So when lending slows, the creation of new money slows. And when new money slows, economic activity slows. Spending decreases. Businesses earn less. Layoffs begin. And as incomes fall, more people struggle to service their debt, which leads to more defaults, which leads to even tighter lending. And this creates a downward spiral, a feedback loop in reverse. This is how a slowdown becomes a crash. But there's another layer that accelerates this process: human behavior. Because markets aren't just driven by numbers, they're driven by psychology. During the expansion phase, people become optimistic. They believe risks are low. They believe opportunities are everywhere. They believe prices will continue rising. And this leads to overconfidence. But during the downturn, that psychology flips. Fear replaces confidence. Uncertainty replaces optimism. And people don't just slow down. They react. They pull money out of investments. They stop borrowing. They start selling. And when enough people do that at the same time, prices don't just fall, they collapse. This is what turns corrections into crashes. It's not just the system, it's how people respond to it. Now combine both forces: a system built on expanding debt, and human behavior that amplifies both growth and decline. That combination is what creates cycles: expansion, peak, decline, crash, recovery, and then back to expansion again. This isn't random, it's structural, and you can see it repeated throughout history. Different markets, different triggers, same pattern. But here's where things become more serious. Because over time, the system has evolved. It's become more complex, more interconnected, and more dependent on debt than ever before. Today, banks, governments, and corporations are deeply linked. Financial systems across countries are connected, which means when something breaks, it doesn't stay isolated. It spreads faster, wider, and with greater impact. This is why modern crises feel bigger, because the system itself is bigger, more leveraged, more sensitive. And when pressure builds, the consequences are amplified. Now this is where intervention comes in, because when the system starts to collapse, authorities step in to stabilize it. Central banks lower interest rates. They inject liquidity. They create money. Governments increase spending. They support businesses. They try to restore confidence. And in many cases, it works. The system stabilizes. Markets recover. Growth returns. But there's a trade-off, because every time the system is supported like this, it prevents a full reset. Debt doesn't fully clear. Imbalances don't completely disappear. Instead, they are carried forward. And often, they grow even larger, which means the next cycle starts from a higher level of debt, a more sensitive system, and a greater reliance on intervention. This creates a long-term pattern. Each cycle becomes bigger. Each recovery requires more support. Each expansion builds more pressure, until eventually, the system becomes heavily dependent on continuous support, like something that can't function on its own. And that raises a serious question. How sustainable is that? Because if the system requires constant expansion, constant borrowing, constant intervention, then what happens when those tools become less effective? What happens when lowering interest rates no longer stimulates enough growth? What happens when debt levels become too high to expand further? What happens when confidence can't be restored as easily? These are the conditions where systems become unstable, not immediately, but gradually, and then suddenly. Because most of the time, the system appears stable right up until the moment it isn't. That's the nature of these cycles. They build slowly, quietly, and then they break quickly, loudly. And when they break, they reveal something important. That stability in this system is temporary, because it depends on continuous expansion, and continuous expansion has limits. Now here's the key takeaway. Crashes are not random events. They are the result of built-up pressure within a system that depends on growth. They are the release of that pressure, a reset. And while they may look chaotic on the surface, they follow a pattern underneath. A pattern driven by debt, amplified by human behavior, and managed, but never eliminated, by intervention. Which means one thing is almost certain. The cycle will continue. Expansion will return, growth will resume, and eventually, pressure will build again. And when it does, another crash will follow. Because once you see the pattern, you stop being surprised by it. You start recognizing the signals: rising debt, easy money, rapid growth, increasing risk-taking. These aren't just signs of opportunity, they're also warnings. Because in a system like this, what looks like stability is often just the build-up before the next shift. And that shift isn't random. It's part of the cycle. Expansion, pressure, collapse, reset, and then it begins again. So the real question isn't whether the system will crash again. It's when. And more importantly, what you do with that understanding. Because once you understand how the system works, you're no longer reacting to it blindly. You're seeing it for what it is, a cycle. And cycles can be studied, they can be anticipated, and in some cases, they can be used. Which leads to the most important question of all. If the system is built this way, if crashes are inevitable, if cycles will continue, then how do you actually win in a system like this? How do you position yourself not just to survive these cycles, but to take advantage of them? That's what we're going to break down next. In the next episode, we're going to take everything you've learned in this series and show you how to navigate this system strategically, so you're not just affected by it, but positioned to benefit from it.